Today's the Bank of Canada interest rate announcement and release of monetary policy report, and I'm really hoping that they come out and they admit that we're in a recession.
Canada managed to dodge a recession.
So you can see that the Canadian economy was slowing down.
We keep hearing about recession.
And now Deloitte Canada is forecasting that we'll skirt a recession this year too.
And that rates can't come down until employment goes up. In today's video, we're gonna go over why the numbers are worse than you think and what needs to happen for the rates to start coming down. I think we're all on the same page. Rates won't be dropping today, and our best case scenario is a June drop, but the probability of that happening just dropped from 75% to 66%. These are the important factors that we need to look at when we're considering where rates are going and how quickly they could fall. What stands out in this chart is the increase of unemployment rate. This is the largest monthly jump since mid-2022. That puts us back above 6% for the first time since 2017 if we ignore the pandemic surge. As a refresher, anytime the 3-month average unemployment rate rises 0.6% above the 12-month low in Canada, it is a very strong indicator that the economy is heading towards a recession. Over the past century, this measure has generated only one false positive back in 1996. We're now nearly 90 basis points above the 12-month low, a level that has 100% historical track record of predicting a recession. Hours worked, which matter for GDP, fell month over month and is the largest decline since November. That puts the annual growth rate at just 0.7%, the weakest since the lows during the pandemic. The rate is down 90 basis points below where it was just 1 year ago, an annual decline that has consistently pointed to a recession in the past. I think it's pretty clear that massive immigration and overall population growth is outpacing job creation, leading to an overall loosening in the labor market. We are now seeing a sharp increase in the share of unemployed who have been without work for more than 27 weeks. A clear sign that jobs are getting harder to find. Just look at this Bank of Canada business survey. The labor shortages have fallen to levels of the pandemic and financial crisis before that. Just give it time for the data to do its thing, and we're gonna see wages begin to reflect the spreading weakness in the labor market. A softening labor market is always necessary to break inflation expectations and to give Bank of Canada a reason to cut rates. If we want lower rates, the trade-off has always been higher unemployment rates, unfortunately. All right, quick pause on this video. Listen, before I say anything, this isn't coming from me, this is coming from the entire team. We need more subs. A lot of our viewers are still not subscribed, so please like, share, and comment below on the type of content that you'd like to see next. The immigration minister just announced a major overhaul of the non-permanent resident programs. The key announcement was that the feds will aim to reduce the NPR to 5% of the total population within 3 years. Keep in mind, this is some of the fastest population growth that Canada's ever seen, so no wonder we're outpacing job creation, why rental vacancy rates are at an all-time low, and why unemployment numbers are growing. Population numbers grew way too fast and the government didn't consider long-term effects. The government is making drastic changes like shrinking the NPR cohort by 600,000 people over the next 3 years, but regardless, with higher rates and a slower economy, less businesses will need new temporary workers. The most recent inflation data came in at 2.8%. We've moved a lot closer to that central bank's inflation target of 2%, but shelter continues to be the largest driver of inflation, up 6.5%. Inflation is the most important driving factor behind the Bank of Canada's rate decision. For Bank of Canada to hit its inflation target of 2%, it needs to adjust its policy interest rates to control inflation, but we might be at a point where we need to get used to higher inflation and we might have to adjust our inflation target to 3% rather than push the entire economy into a tailspin to stay below 2%. So where do we see rates going this year? Well, the economy is showing strong signs of slowing down, and some of the lagging data like growing unemployment, debt, and business insolvencies take time to realize in the market, and we could see a big shift and hopefully some bigger rate drops later in the year. I'm gonna make a rate prediction for our October 23rd, 2024 rate meeting. My prediction is that we're gonna be 0.75 to 1% lower than we are today.